I've never said that the Fed will never pivot. My point was they'll pivot too late. They'll pivot. They won't pivot when the market expects. Right now, the expectation, maybe it's cooled off a little bit, but the expectation was that the pivot would come as early as January or February 2023. That's the signal that the inverted Eurodollar futures curve is sending. Wages were up 5% on an annualized basis. It's like, yeah, that's nominal, and inflation's 8. So you're down 3. People are losing money.
Yeah.
But so yeah, the Fed will pivot eventually, but it'll be too late. It'll be after the damage is done, after we're in a deep recession, unemployment rising. Because remember, they've baked higher unemployment into the pie. When unemployment starts to go up, and I believe it will soon, they're going to say, yeah, we told you, we told you there's going to be some pain. And they only look at the unemployment rate. They're not looking at labor force participation, which we talked about. So if unemployment goes from 3.5 to 4, 4.25, 4.5, that is not going to be enough to dissuade the Fed. That's not going to get them to stop raising rates, because they're only worried about inflation. Now, there's some level where they'll care, but is that 6? I mean, it might be 6%. But when we get to 6% unemployment, we're on our way to 8. I mean, that's where the wheels are coming off. Inverted yield curves are signaling January. The Fed's not looking at them. The Fed doesn't care. The Fed doesn't understand them. The Fed has got one goal in mind, which is to kill inflation. Good luck starting at 8. And by the way, we haven't even talked about the fact that this inflation is cost push. It's coming from the supply side, which is completely different than demand side. I mean, I lived in the 70s. It started as cost push with the Arab oil embargo and quadrupling of oil prices, but it flipped into demand, what's called demand pull, which was, that's a little more like too much money chasing too few goods in the late 70s. So we had both, but we had them sequentially. Right now, we only have cost push. We have supply shocks. By the way, I'm shameless about plugging my new book, Sold Out. It's a book about the collapsing supply chain, but it has chapters on inflation, 3 chapters on the supply chain, and then inflation, and then talks about deflation, which we haven't even talked about that, but that may be the real danger. So right now, the inflation is coming from the supply side. It's coming from energy price increases, which are obvious, shortages. And the problem in Europe, I wrote the other day, I said there comes a time when the price doesn't matter because you can't get the energy at any price, where it's actually, there actually isn't any. Bid whatever you want, but there just isn't any. And Europe's getting close to that point. But as far as monetary policy is concerned, the Fed doesn't drill for oil. Fed doesn't drive a truck. Fed doesn't plow farms and pick corn and all that stuff. They can't do anything about it. What they can do is destroy demand, but because it's not coming from the demand side, you've got to do like twice as much destruction to really cool off the supply side. As I say, in the 70s, it did flip. And again, going back to the narrative thing, where demand pull inflation is scary, because the name comes from the fact that you're pulling demand forward. And I remember in the 70s, if you wanted a new car or refrigerator, you said to yourself, I better go buy it now, because it's going to be more expensive 3 months from now or 6 months. It's going to cost me a lot if I wait. That is not true today. That has not kicked in. The inflationary expectations are not up that much. People are feeling the price increases, real CPI. There's no doubt about that. But people have tended to say, yeah, that's really bad. And if I got to, the demand for gasoline is kind of inelastic if you got to go to work or whatever. But the way people afford it is they say, well, we're not going out for dinner this weekend, or I'm not going to buy a new winter wardrobe, or we're not going to take a vacation. So you do destroy demand in other sectors, more elastic sectors than oil, than gas and diesel. But the price increases are real. It's causing real damage, but it's nothing the Fed can do anything about. Now, every day you get a little closer to that demand pull. You get a little closer to that change in psychology. We're not there yet, but if this supply side inflation persists, we may get there, and then forget it. Now you're on your way to 15% inflation. Here's another irony, having just resurfaced from a deep dive in the supply chain. There's something called the bullwhip effect, but so go back to last November. So central bank digital currency is not a cryptocurrency. It's issued by a central bank. It's not going to be on the blockchain. Could be, but it's not. It's going to be. It has to be a ledger. A digital dollar, central bank digital currency. A digital dollar is still a dollar. A digital euro is still a euro. A digital yuan is still a yuan. So it's not really a new currency. It is a new payment channel. It is a new way of distributing the currency. And by the way, the rollout of the central bank digital currency, and this just to kind of answer your question on the executive order, China's gone full speed ahead. China already has one. It's in the pilot program stage. If you were at the Winter Olympics in last January or February rather, you had to buy your tickets and your meals with the QR code on your iPhone, which was this digital yuan. And Europe is not quite there yet, but they're moving very fast, very fast. The US was taking their time. The Fed was conservative. They had a joint research project with MIT. They're like, oh yeah, we can kind of see this coming, but we're the dollar and we want to take our time. That changed with that executive order. This has now been put full speed ahead. This has been accelerated because the Fed sees the horses leaving the barn, so to speak, and they want to get their digital dollar out very quickly. Now, this goes hand in hand with the elimination of cash. Kind of a separate subject, but our friend Ken Rogoff, The Curse of Cash, just get that book and read it because there's the manifesto for getting rid of cash. What do they have to do with each other? Well, when you have a central bank digital currency, and by the way, just for bank stock investors or maybe MasterCard, you can disintermediate the entire banking system with a digital currency. So the way right now, I go to buy, I bought a candy bar in an airport yesterday. I use a credit card. Well, so I'm the customer, buy the candy bar, I pay for it with a credit card. The retailer has a receivable, and there's a factor called the merchant acquirer. Merchant acquirer bundles up all these receivables from retailers in the hundreds of millions. So they buy them, retailer gets paid. They then deliver them to MasterCard or Visa and say, pay me. MasterCard and Visa pay the merchant acquirer. Then the merchant acquirer, the MasterCard and Visa distribute the receivables to the banks that issue the card. And then my bank sends me a bill and I pay the bill. The Fed won't actually disintermediate the banks because the Fed was created in 1913 for the sole purpose of propping up the banks. Forget about dual mandate and all the green. MasterCard might, but the US government doesn't. But now if my currency transaction has to go through, but now they'll send it out in a digital form and they'll say it's only good for 30 days. Because we're a little, use it or lose it. We're a little bit worried about aggregate demand here. So we're giving you the money, but you got to spend it in 30 days or it disappears. Or just do it to your bank account. It doesn't even have to be a new check. We're gonna whack your bank account, 1% a month, not as a negative interest rate, but if you spend it, we won't. So the applications of this are horrendous. It's all straight out of George Orwell. And if you take away cash, then you don't have a workaround. At that point, the only workaround is gold, silver, and real estate's a good store of wealth. I think it'll do well, but you can't spend it. A mortgage in China, the way it works is you take out your mortgage, you sign the mortgage note, and the money, and you put your down payment down, but there's no house. They then use the money to build the house and deliver it to you. But people get mortgages on houses before they're built. In effect, you're financing the developer. Well, what happened was the developers stole all the money and they got all these unfinished houses. But the banks are saying, hey, you still got to pay the mortgage. Sorry, you signed up. So now there are mortgage strikes in China and they're spreading.